Hey traders, it's Christopher Mullen here from SpikeAlerts.com showing you how one weird tick can help you find some pretty easy day trades. And not only day trades, but to help you adjust and manage any other open positions you have because it's going to give you insight into which way the market is going to trade tomorrow and how far it is likely to move. So as a subscriber to the service, you'll see in the top right-hand corner the login button, and it'll take you into the Technical Traders, which is our platform. It'll show any subscriptions that you have there. You'll see here at the top here, spikealerts.com. You'll enter the members area. As a member, you have access to all the past trade alerts. You can see all the recent charts and updates. The way it works is all alerts and updates are posted on this home page. So you'll have the title, a little bit of a brief info about what's going on, and a chart explaining that. So let me just quickly walk you through the menu here. This how to trade price spikes video is this video you're watching now. So you can watch it again and wrap your head around how to enter trades, how to manage positions, what to do when targets are hit. Trading tools, I can talk about that at the very end, but you've got the economic data table, which is a pretty interesting little tool for short-term traders, day traders on economic data, and of course just a holiday calendar talking about when the market is closed. So let's just move over here to the most recent or the last couple of price spikes. So this is September 12th. You can see at the top there, this is the SPY spike alert. Now let me cover a couple things really quick here. Spike alerts happen, I follow them in the SPY, USO, GDX, GLD ETFs. Now, I only use the ETFs because that's where I've only been able to find them. That being said, for this example, it's the SPY. If we have a spike up in the SPY, you can trade anything related to the SPY. And you could trade a 1 times, 2 times, 3 times leveraged ETF. You could do spread betting, contracts of difference, CFDs, binary options. You could trade futures, which is my preferred investment vehicle for this because it's short term, and the moves are somewhat small percentage basis, so it's nice to jack up the leverage. 3 times ETFs work well also. But you can trade anything you want based on that. You just have to expect the SP 500 to move higher the next day. So let me walk you through what a spike alert is, its characteristics, and how to trade it. Here you've got the spike alert I sent out in 7:51 a.m. September 12th in the morning, pre-market trading, showing where we had a price spike, showing you where we're looking to put our targets. Typically, I put a target around a third of the move, 50% of the move, and 80 to 100% of the move. Now, what the market does, what are these price spikes? Maybe you're asking yourself. To be honest, I have spoken to a lot of different traders, and we all have a different theory. To me, in the grand scheme of things, it doesn't matter, but I have a feeling it is some type of big positions that when the market closes, it usually happens when in pre-market or post-market. Those are the only spikes I use. I don't use any intraday. So it's some type of system that either moves a bunch of shares and trades them and shows where price is likely to move the next day, where the market makers are probably going to be walking the price, or where the bias is for the day. You can dissect it any way you want, but the point of the story is it's the market tipping its hand, showing us where the likely direction is for these significant filtered spikes. So what the market tries to do is when we do get a big spike like this, the market seems to try and shake everyone off the boat. So instead of it just running up, many times it will just start to run up, hit these targets, but what it does more times than not is goes against that move, shakes the market out, moving beyond a certain comfort zone, and then eventually it'll reverse and move up and start to hit these targets. So there's 2 ways you can trade it. Typically, when you get the spike alert, you can put on a small position in case it just takes off, but you can add a balance of the position after you've got to move against it, because the market likes to move against it more times than not before it reverses. And so let's just move up to see how this unfolded here. So I gave out the spike alert. It was somewhere right down here in early morning, 7:51. And the market, I was anticipating that we had a huge sell-off. This was a big sell-off in this stock market. And I expected, because we closed at the lows of the day, I expected more fear and carry over to the next day, which is why this spike alert wasn't sent out post-market. I was anticipating a gap down, which we did. So I sent this out around 7:51. And the market since from there rallied all the way up and tagged the first level. And you can see here price time 10:30. So we got in the morning. By 10:29 we had hit our first target. If you're trading just one futures contract, it was $1,100, and quick profits were pretty much just moved in our favor the entire way and kept going up to that level. So very simple. These moves are usually imminent. All spike alerts typically, if they don't get filled within 48 hours, then the trade is more or less void, and you want to just exit the position because that signal just it didn't come to fruition, didn't play out. And what I do with stops is I usually take the spike level, so the entire spike level, and I flip it to the downside. And that's kind of the downside level. And of course, if price doesn't move in our favor or fill the target within 48 hours, we just simply close the position no matter where it is. Could be trading at a loss, could be still somewhere in the zone, but you want to pretty much close that position because it seems that after 48 hours, the market tipping its hand, trying to walk the market in that direction, no longer is in play. And usually we'll have a new spike by then anyway, kind of showing us where the new kind of short-term bias for the market is. Now let's take a look at the next alert that we had. This was the very next day, September 13th, 4:15 p.m. So the market closed. We got a spike up in the market. You can see here it's kind of hard to see on the chart, but there's a spike all the way up. I drew in the third 50% spike fill and 100% spike fill targets. The key here is that whenever you hit a target, you need to either move your stop up to break even or higher and take some profits off the table. If you don't, the market will pretty much take your money away. You have to take the money out of the market in order to lock in gains, or eventually the market will just simply take your money and keep taking it every time you enter a trade. So you can see here we had a spike to the upside, which actually bode really well with this gap down we had. Usually gaps get filled. So the fact that we had a huge spike up, that was a great sign that we were probably going to get a gap fill and a move up. Not always do we get those moves, but the key here is to focus on the first target because that is the most likely target to be reached before the market will have some type of bias and may want to roll over. Now to quickly just touch on this other trade, this is the spike trade from the day before. We can see from our alert, we came all the way up, we blew past, we came right up to this spike alert high, and then the market got overbought, and of course we had a big sell-off to the downside, and in a short-term basis, this day down here was somewhat oversold also, and so a spike to the upside was favoring a move up. Now if we take a look at how that unfolded the following session, this is the next day on the 14th at 11:09. Really, our spike fill, our first target was filled and reached, I think around 9:45 or so in the morning. But either way, we had our spike here, which is tough to see because I over zoomed in on the chart. This spike here actually continued to move higher. It went all the way up into the 216 level, but this was our first spike target, which was hit right after the opening bell. Price jumped up, hit that level, and from the spike alert to there, it was a $450 profit on the ES, pretty much entering a trade post-market, waking up the next morning, and shortly after the opening bell, the next profit target was hit. And of course, once a target is hit, you need to move your stop to either break even on the balance of your position or move it up even higher to reduce risk. If you don't, then you can you'll give back any of the gains you have if you don't move your stop up on the balance of your position. So that is how Spike Alerts works. It's an email, SMS text alert, and members area service. So every time there is an update or a spike alert, you are sent an email, an SMS text message to your mobile phone, which you would need to go to your profile page. You go to My Account, there'll be a profile button, click that. You add your mobile phone to the SMS text area to be sure that you get the alerts. And you can log into the members area to view the charts. Sometimes we do send the emails with the charts in them, but depending if your email provider provides HTML emails or not, you may not be able to see the charts. So if you do get an alert, it's always best to log into the members area, especially if you just see the SMS text alert, because text alerts, you're only allowed a certain amount of characters. So you might only see a little bit of the message and you won't see the chart. Ideally, you want to log in so you can read the entire message, view the chart, and then take action from there. Hopefully this helps explain what Spike Alerts is. Take care. Bye-bye.